Hey everyone, welcome to Alpha Insights. I'm Harper.
And I'm Jamie. Great to have you with us. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Quick note up front. US markets are closed today for the holiday. So when we talk prices, we'll say things like, as of Friday, February 13th, or talk about heading into the long weekend.
Exactly. We can still unpack how the market works without confusing it with today's trading. Let's dive into the basics. Who does what in the market?
Right, so first, exchanges. Think of them as the regulated marketplaces, the New York Stock Exchange, or NASDAQ, where listed stocks are available to trade and where trades are recorded.
And then you've got brokers, your gateway. Brokers take your order, check compliance, and route it somewhere. An exchange, a market maker, or sometimes an internal matching engine. Different brokers route differently, so execution quality can vary.
And market makers. They're the folks who post continuous bids and asks so you don't have to wait forever for a match. They earn a little on the spread, and that liquidity keeps big orders from blowing the price out of the water.
Exactly. Which leads us to how you actually tell the market what to do. Order types.
The real question here is, do you want speed or price control?
Market orders are speed first. You say buy or sell now, and the broker executes at the best available price. Use those for very liquid stocks when execution certainty is more important than getting an exact price.
For example, if you place a market buy for 100 shares of Apple and the best ask is $150.05, your fill will likely be around that price. So roughly 100 shares at about $150 each, which comes to around $15,000.
Right, but in faster or thinner markets, the actual fill can be worse. That's where limit orders come in. You set the maximum you'll pay or the minimum you'll accept. Price control, but no guarantee of a fill.
So if you put in a limit buy for Tesla at $650, it will only execute at $650 or better. If it never gets that low, you don't get filled.
And stop orders are the safety net people use to limit losses. A stop sell becomes a market order once the trigger price is hit. A stop limit becomes a limit order at the trigger. It protects against crazy fills, but it can also fail to execute.
For instance, say you bought Tesla at $700 and put a stop sell at $650. If bad news makes the stock plunge, that stop could become a market sell and fill at $640 or lower.
Exactly. So you trade off the certainty of execution with the certainty of price.
Let's step back and talk price discovery. It's basically supply and demand doing their thing. The last traded price is simply the most recent agreement between a buyer and a seller.
Picture a farmer's market. Sellers display apples. Buyers shout what they'll pay. If no one buys, sellers lower their price. If buyers compete, prices go up. That's price discovery in a nutshell.
And the bid-ask spread is the immediate cost of trading. The bid is what buyers will pay. The ask is what sellers want. A wider spread means higher implicit cost, especially in volatile or thinly traded names.
Market depth matters too. Visible orders beyond the best bid and ask. Thin depth means even a moderately sized order can move the price a lot. Deep depth soaks up bigger orders with less movement.
Execution and then settlement are the final steps. Execution happens when your order matches and you get a fill. Settlement is the legal exchange of cash and shares. In U.S. equities, that typically happens 2 business days after the trade date.
So your account might show a pending trade before settlement completes. And you can't always assume proceeds are immediately usable for new trades, unless you're on margin or follow specific rules.
Let's run a couple of quick, practical examples so this feels concrete. Buying a liquid stock. Market buy 100 shares of Apple. Tiny spread, low execution risk. Selling a thinly traded stock. A market sell of 1,000 shares can push the bid down sharply, so you'd rather use limits or work the order in chunks.
And using a stop on Amazon. If you bought Amazon at $110 and put a stop at $100, a fast drop could see your stop fill well below that trigger. So consider whether you want the protection or whether a stop limit makes more sense. With the caveat, it might never fill.
I mean, when you look at the data, the common mistakes are the same. Trading on emotion, ignoring order types, and underestimating costs.
Yeah, that's a good point. Even with zero commissions, spreads and slippage add up. Also check your broker's routing practices if execution quality is important to you.
Short reactions.
Right.
Interesting.
To wrap up, 3 quick takeaways. Know your order types and use them intentionally. Be mindful of bid-ask spreads and market depth. And understand settlement timing and broker routing.
Exactly. Practice in a paper account, check your broker's execution reports, and start small so you can measure slippage and real costs.
Got questions? We'd love to hear them. Head over to stockalpha.ai, where you can ask us anything, and we'll answer live. And while you're there, check out more market content.
Thanks for listening. We'll be back after markets reopen. Until then, take a breath, think about your order strategy, and enjoy the holiday.